Welcome back to Deception Reports. Today, we dive into one of history's most infamous corporate collapses, the Enron Scandal. Let's go to the billion-dollar collapse. Enron Exposed. It's a jaw-dropping tale of fake profits, hidden debt, and a massive lie that fooled Wall Street, investors, and the American public for years. This is the story of the billion-dollar fraud that brought down one of the most powerful and seemingly innovative companies in America. Back in 2001, if you looked at the headlines, a company named Enron was everywhere. It was celebrated as one of the most forward-thinking corporations in the country. Wall Street analysts adored it, showering it with buy ratings. Powerful politicians trusted its leaders, and its own employees, many of whom invested their life savings in company stock, truly believed they were part of something revolutionary. But behind the curtain of innovation and soaring stock prices, Enron was secretly rotting from the inside, concealing one of the largest and most audacious accounting frauds in U.S. history. This is the true story of how a billion-dollar lie was carefully constructed, maintained, and ultimately, how it all came crashing down. So, what exactly was the Enron scandal? In simple terms, it was a massive, systematic, corporate accounting fraud. Enron's top executives used a complex web of deceptive accounting practices to hide billions of dollars in debt from failed deals and business ventures. They essentially created a fantasy version of their company, one that showed massive profits and steady growth, while the reality was mounting losses and financial instability. When the truth finally burst into the open in late 2001, the illusion shattered. Enron collapsed almost overnight, filing for what was then the largest bankruptcy in American history. This catastrophic event, which we now refer to as the 2001 Enron Scandal, sent shockwaves through the financial world and fundamentally changed the rules of the game for how American companies are regulated. To understand how this happened, let's go back to the beginning. Enron started its life as a fairly traditional energy company based in Houston, Texas, primarily dealing with natural gas pipelines. But during the tech boom of the 1990s, Enron underwent a radical transformation. It rebranded itself as a new economy energy trading giant. It didn't just move gas anymore. It created markets for and traded everything from electricity and natural gas contracts to more exotic things like internet, bandwidth, and even weather derivatives. To the outside world, this looked like the future of business. At its absolute peak, Enron's numbers were staggering. The company was valued at over $70 billion. It employed around 20,000 people globally, and its stock price soared past $90 a share. From every angle, Enron looked unstoppable, a titan of American industry. But internally, the seeds of the Enron company scandal were already sprouting, watered by a culture of arrogance and a relentless pressure to meet unrealistic profit targets. Of course, a fraud of this magnitude couldn't be pulled off by just one person. Several key figures were at the heart of the Enron fraud scandal. First, there was Kenneth Lay, the company's founder and chairman, the public face of Enron who projected an image of integrity and vision. Then there was Jeffrey Skilling, the hard-charging CEO who was a major proponent of the aggressive and questionable accounting methods that became Enron's signature. Skilling championed a high-pressure, performance-obsessed culture where making the numbers was all that mattered. But the true architect of the financial deception, the man who built the house of cards, was the chief financial officer, Andrew Fastow. Fastow was the mastermind behind the Enron accounting scandal's most intricate schemes. He created a labyrinth of off-the-books partnerships, shell companies with bizarre names like Raptor and Chuco. The primary purpose of these entities was to serve as a dumping ground for Enron's massive debt and poorly performing assets. On paper, these transactions were structured to look legal, but in reality, they were a deeply unethical way to mislead investors and regulators. This is where the story of what happened at Enron becomes truly shocking and complex. Fastow wasn't just hiding debt. He was personally enriching himself, running some of these partnerships and earning millions in management fees, creating a massive conflict of interest. So let's try to explain the Enron scandal in the simplest terms possible. It boils down to two main tricks. First, Enron aggressively used an accounting method called mark-to-market. Typically, a company records revenue when it actually receives the money. Between mark-to-market, Enron could book the estimated future profits from a long-term deal the moment the contract was signed. So, If they signed a 20-year electricity supply deal, they could claim all 20 years of projected profit immediately in that single quarter. The problem was, these were just projections. If the deal went sour or the projections were wrong, the money would never actually arrive. But on the financial statements, Enron looked incredibly profitable. The second trick was what they did with their losses. All the bad investments and failing business units were secretly moved off Enron's main balance sheet and into those special purpose entities, the shell companies created by Andrew Fastow. So, to an investor reading the official reports, Enron's profits appeared to be soaring while its debt seemed incredibly low. In reality, the exact opposite was happening. This sophisticated accounting scandal successfully fooled nearly everyone. Seasoned Wall Street analysts, financial journalists, and even the regulators who were supposed to be the watchdogs. But how could this happen? Weren't there auditors to check the books? This brings us to another major player in the scandal, Arthur Andersen, which at the time was one of the big 5 and most respected accounting firms in America. Their job was to audit Enron's financial statements and ensure they were accurate and fair. But instead of acting as an independent watchdog and stopping the fraud, Arthur Andersen essentially became a willing accomplice. They signed off on Enron's misleading financial reports year after year, giving them a clean bill of health. Why? Because Enron was a massive client, paying them millions, not just for auditing but for consulting services as well. When the scandal began to unravel, it was revealed that Arthur Andersen executives had ordered the shredding and destruction of thousands of critical audit documents in an attempt to cover up their involvement. The Arthur Andersen Enron scandal was a scandal within a scandal. The firm was ultimately convicted of obstruction of justice, and this once great accounting giant completely collapsed, effectively going out of business. It was a stark and terrifying demonstration of how dangerous weak corporate oversight can be. So, let's put this on a timeline. When did the Enron scandal finally break? The walls started closing in throughout 2001, as journalists and a few skeptical analysts began asking tough questions. By the fall, the company was forced to admit to massive accounting errors. The stock price, once over $90, plummeted to less than $1. Finally, on December 2, 2001, Enron filed for bankruptcy protection. The fallout was swift and brutal. By 2002, the U.S. Congress responded by passing the Sarbanes-Oxley Act, a landmark piece of legislation designed to prevent another Enron. This law dramatically increased accounting regulations, introduced stricter penalties for corporate fraud, and placed a much greater personal responsibility on CEOs and CFOs to certify the accuracy of their company's financial reports. The human cost of the Enron scandal was devastating. Tens of thousands of employees lost their jobs. Even worse, many had invested their entire retirement savings, their 401 kiloseconds, in Enron stock, and they watched it all turn to dust overnight. They lost everything. Investors, from large pension funds to small individual stockholders, lost billions of dollars. Justice did eventually come for the key players. Top executives, including Jeffrey Skilling and Andrew Fastow, were arrested, convicted of fraud and other crimes, and sent to federal prison. Kenley died of a heart attack before he could be sentenced. Today, the Enron scandal is a mandatory case study in every business school and ethics class around the world. It serves as the ultimate cautionary tale of corporate greed, arrogance, and the catastrophic failure of checks and balances. So, what was the Enron scandal? It was a company built on a foundation of lies. Who was involved? It wasn't just a few rogue traders. It was the top executives, enabled by their trusted auditors. And why does it still matter so much today? Because the Enron Corporation scandal fundamentally altered the landscape of American financial law and corporate governance. It's a permanent reminder that trust is the most valuable currency in business, and once broken, it can bring even the meatiest giants to their knees. The Enron story wasn't just about money or accounting rules. It was about trust. The trust we place in corporations, in their leaders, and in the systems designed to protect us. And it showed us just how fragile that trust can be. If you want to hear more true stories about deception, fraud, and justice, make sure to subscribe to the channel. Thanks for watching. This was the Enron Scandal.